Welcome back to Investing Talk Podcast.
Today we're looking at LM Funding America.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And this is one of the most compelling operational turnaround stories we've seen in a while.
Really? Why is that?
Because for months, this company was basically, invisible to any serious investor. It was just buried under this avalanche of regulatory and financial uncertainty.
Okay.
And you really have to understand that historical fear to appreciate just how dramatic the recent shift has been.
So when you say historical fear, we're not just talking about a few bumps in the road, are we? I mean, this sounds more serious.
Yeah, much more. We are talking about legitimate existential threats. Threats that made a lot of investors, frankly, assume this company was just headed for ruin.
So what was it? What was the regulatory issue that was clouding the whole picture?
It was serious, and it all centered on their financial reporting. The major issue was their annual report, the Form 10-K, for fiscal year 2023.
Right.
They announced a huge delay, said they needed more time to finalize the audit, and this is the critical part, to reassess their own internal controls.
And just to clarify for our listeners, a 10-K isn't just some document, right? It's the definitive audited statement of a company's health.
Exactly. And delaying it once is bad enough.
But this was the second year in a row, wasn't it?
It was. And that repetition just amplified the concern tenfold. I mean, when a company misses an SEC deadline like that twice, it's not a warning sign. It's a full-blown alarm bell. It signals a fundamental breakdown somewhere.
And that breakdown triggers the most painful consequence for a public company, the threat of being delisted.
Absolutely. By late 2023, that's exactly what happened. They got a formal notice from Nasdaq.
Yeah.
And when they couldn't file those missing reports, they were officially at risk of delisting proceedings.
So you have a complete vacuum of information.
A total vacuum. You can't do fundamental analysis without audited statements, so investors were just forced to speculate.
I remember hearing whispers back then, Q3 2024, I think, that some shorts were even talking about a potential Chapter 11 bankruptcy filing.
That's right. The stock price was basically pricing in a near-certain failure. The whole narrative was collapse.
Yeah.
And that's what sets the stage for the pivot we're seeing now. That lack of transparency is gone. And the Q1 2025 results, they've just completely changed the story.
Okay, so let's move out of that regulatory dark age and into the now. I'm going to need some hard numbers to counteract that level of fear. How dramatic was the turnaround in that Q1 statement?
The shift is, it's undeniable. Revenue for Q1 came in at $14.8 million.
Okay.
That's a solid 12.4% jump year over year. But the truly staggering change is the bottom line, the move to profitability.
So what are we talking about?
They went from a net loss of $26 million in Q1 of last year to a net income of $1.1 million this Q1.
That's nearly a $2 million swing in just 1 year.
A huge swing.
A positive net income is great, but for a lender, the real story is always in the margins, right? What happened to their gross margin?
This is the data point that validates the whole thing. Their gross profit margin expanded significantly. It jumped from 44.3% to 52.1%.
Wow. That's a 780 basis point expansion, almost 8 percentage points. That doesn't just happen by accident.
Yep.
What's driving that kind of efficiency gain?
There are two main drivers. First, they made a strategic call to in-house their recovery operations. So instead of paying expensive third-party collectors.
They brought it all in-house. Makes sense.
Exactly. And they saw a massive 19% quarter-over-quarter drop in those fees. They're just capturing that margin for themselves now.
Okay, so that's one driver. What's the other one?
It's on the front end. Better underwriting. They're seeing lower default rates on new loans, which means the businesses they're funding are just higher quality.
Okay, but hold on. Given all the past issues with internal controls, how can we actually trust these new numbers? I mean, how do we know this profit swing is real and sustainable?
That is the critical question. And the confidence really comes from two places: management's own aggressive actions and the immediate analyst response. Management was so confident, they immediately raised their 2025 EBITDA guidance.
And raising guidance by, what was it, 43% at the midpoint? That's a real signal?
A huge signal. They went from a range of $5 to $7 million up to $8 to $10 million. You don't do that unless you're certain, and the analysts agreed instantly.
I saw those revisions. Consensus EPS for 2025 jumped from 8 cents to 14 cents, and 3 upgrades just since March.
Exactly. The financial community is validating the recovery. And the reason they believe it's sustainable, That leads us to their core technology. This isn't just a generic lender. They're using proprietary AI.
Okay, but AI-driven gets thrown around a lot these days. What is their auto score model actually doing that's different?
This is their competitive moat. It's all about using what they call alternative data, things that traditional models like FICO scores just completely miss.
Unpack that for me. What kind of alternative data are we talking about?
We're talking about real-time operational data, things like direct bank feed integration, point-of-sale transaction velocity, so how fast sales are coming in, even tax filing patterns. They can price risk 3 times faster than their competitors.
So instead of a credit history from 5 years ago, they know how many sales a business made yesterday afternoon.
Precisely. It's like having a live feed into the health of their clients. And the results prove it works. Their default rates dropped to just 12.1% in Q1.
And the industry average is, what, around 17.5%?
That's right.
So that 5.4 percentage point difference, that's the whole game right there. That's where that massive margin expansion is coming from.
That is the entire engine of their profitability. And on top of that, once a merchant is integrated into their system, the switching costs are pretty significant.
What kind of disruption are we talking about?
You're looking at an estimated 15 to 30 days of operational headache to migrate to a new lender. That friction creates a powerful lock-in effect.
Which gives them a lot of certainty on future revenue.
Okay, let's look at the financials supporting all this. How healthy is the balance sheet now?
Surprisingly healthy. It's another huge point of inflection. They've shifted from a net debt position to a net cash position of over $7.1 million.
And how does that break down?
It's about $18.2 million in cash and equivalents versus only $11.1 million in total debt. They've got a really comfortable cushion, and they're generating great cash flow.
How strong is that free cash flow?
It was a positive $4.9 million in Q1 alone. They're very efficient at converting profit into actual cash.
So what are they doing with that cash? Are they just sitting on it?
No, they're signaling confidence. They used $3.5 million to buy back their own shares. That took about 7.2% of the float off the market. That's one of the strongest signals management can send.
Speaking of signals, what about insiders? Are they buying with their own money?
Oh, yeah. The CEO and CFO together bought over 105,000 shares in early 2025. You only do that when you think your stock is deeply undervalued. And it's not just them, right? Like, institutions are starting to take notice.
That's right. Lighthouse Investment Partners came in and took a brand new position, 1.1 million shares. That's about 9% of the float. That's a huge validation signal to the rest of the market.
So the fundamentals, the insiders, what's the stock chart telling us?
The chart is textbook bullish right now. It just confirmed a major technical pattern called a golden cross.
Okay, for our listeners, what exactly is a golden cross?
It's when the short-term momentum, the 50-day moving average, crosses above the long-term momentum, the 200-day. It basically signals that a long downtrend is officially over and a new long-term uptrend has begun.
And that came after another classic pattern, right?
Yes, leading up to it, the stock formed a beautiful cup and handle pattern. It's a very strong indicator that big investors have been quietly accumulating shares for months.
So the technicals are confirming the fundamentals. All right, looking ahead, what catalysts should we have on our calendars?
The immediate one is Q2 earnings on May 14th. The market's expecting about $15.5 million in revenue, so meeting or beating that would be great.
But the really interesting event is tied back to the AI, I assume.
Absolutely. June 5th is their Investor Day, and they're planning to unveil AutoScore 2.0. And the key thing here is that it expands their AI into a totally new market, invoice factoring.
That's a massive growth runway.
It is. Management estimates this opens up a new addressable market of around $80 million. For a company this size, that is huge.
And you got potential Fed rate cuts later this year, which should help the whole sector.
Right, a nice macro tailwind.
Okay, this all sounds incredibly strong. Let's play devil's advocate. No investment is without risk. What's the main counter-argument here? What's the big vulnerability?
The number one risk, and investors have to be watching this, is concentration risk. Their profitability is heavily reliant on a very small group of customers.
How concentrated are we talking?
It's extreme. In Q1, 78% of their revenue came from just 36 merchants. And it gets even tighter. The top 10 merchants alone accounted for 42% of all their lending.
Okay, that's a tightrope walk. So losing just a handful of those key clients could completely destabilize their entire quarter.
It is the main Achilles heel of the story right now. They say they're working to diversify, but the risk is very real today. And then, of course, there's just the broader reputational risk of the whole sector they operate in.
Right. The CFPB has been known to scrutinize these types of lenders.
Exactly. Even if they're doing everything by the book, which they claim they are, they're still in a neighborhood that gets a lot of regulatory attention.
So when you put it all together, we have a company that pulled itself back from the brink of regulatory failure. They've executed this incredible, quantifiable turnaround driven by proprietary AI. But the market's been slow to catch on, maybe offering some real upside if they can successfully expand and solve that huge client concentration risk.
Don't forget to hit that subscribe button to keep up with all our future analyses.